Hello and good morning or good afternoon, everyone, depending on where you're joining us from today. This panel discussion is part of both our global and UK business summits, and it's an opportunity to review the M&A landscape internationally as we gradually pull away from the COVID crisis. All the evidence is that there is a boom in M&A markets generally, and that sustainability and ESG are definitely flavour of the month, adding to pressure on valuations. So my name is Julian Rose. I'm one of the co-founders of Environment Analyst. And before we go any further, I want to take the time to thank our event partners who've helped to make this summit possible. They are GHD, BST Global, Equitech, WSP, Arcadis, Mott, McDonald, RSK, Atkins and Montrose Environmental. Thank you very much. We would really like you, the audience, to get the most out of this panel discussion by utilising the interactive platforms that we have on offer. The panel discussion is being held here in Livestorm, and at the end of the discussions at around 3:30 p.m. in the UK and 10:30 a.m. Eastern Time, we will move over to Remo, our networking platform, where you can meet the speakers and ask them any further questions face-to-face, and you can also network with other attendees. Here in Livestorm, you can talk to your peers using the chat box, which is to the right of your screen. So please take a moment to say hello. Let us know where you're joining from today. To see this box, you need to open the sidebar, which is an icon on the bottom right-hand corner. There's also a Q&A tab where you can submit your questions to the panel. Please put these in here at any time throughout the discussion, and I will pick them up at the appropriate time in the session. Make sure you upvote the questions you want to hear asked first. And if we run out of time, our speakers will also be in Remo, so you can catch up with them there. Sessions in Livestorm are being recorded and will be available to view on demand. But the network discussion in Remo will not be recorded. This allows you to relax and talk openly in a secure environment. Lastly, we would appreciate you letting us know what you thought of today's panel and any suggestions you have for future events. And so I would appreciate you taking a couple of minutes to complete a short survey that my colleagues are going to post in the chat box. There it is now. Now, let's get on with the event program for today. Before we go on to the panel, I'd like to introduce my colleague and fellow co-founder at Environment Analyst, Liz True, who's going to share some of our own findings in relation to M&A activity from our global market research. Hi, Liz.
Hi, thank you, Julian. And good afternoon or good morning to you all, wherever you are. Thank you for joining us. I'm just waiting for my slides to come up. I can't see them yet. So there we are. Thank you. So I'm not going to talk about what makes for a successful M&A or what to consider when looking at different financial and strategic options. I will leave that to our highly distinguished panelists that we're lucky to have with us today. My task is to set the scene through some market observations and provide a reminder of some of the significant transactions we've seen in recent months. Also taking a look at how M&A activity is impacting the market structure and business performance. And first, if you haven't done so already, I'd like to invite you to take part in the poll. To the right-hand side of the screen, you can see the poll option. Tell us about your company in relation to M&A and strategic ambitions for the next couple of years. And this poll is completely anonymous, by the way, and it's just out of interest. And you can select one or more of these options. So let's have a quick look at that. So we can see that, wow, 2/3 of people are looking to buy in the next couple of years, and only 11% looking to sell. So there does seem a slight mismatch there. I'm sure that's something we'll talk about later on. And 20% looking to explore alternative financial options. So thank you for taking part in that. So first of all, a brief summary of major M&A trends we've observed. Over the last couple of years and last 6 months in particular, we've seen the desire for specialist ESG, climate and sustainability capabilities rise in prominence as a driver for acquisition in the environmental consulting space, but also within the broader professional and technical services industry in its widest sense. And that's alongside digital technology as the other primary driver for firms in our industry. During the first half of 2021, there have been several, mainly small-sized niche sustainability ads from within our global top 25 firms, including by ERM, Ramboll, SLR and Sweco. There is a growing recognition that a sustainability focus offers a route into high-value strategic services as consulting engineering firms seek to move up the value chain, which is also being achieved through divestment and streamlining with the aim to refocus on what they do best. So this is another feature of the recent transaction landscape. On a similar theme, we've seen a more risk-averse approach to geographic expansion of late compared to the early half of the 2010s, particularly when it comes to emerging markets, reflecting the desire to balance out organic and inorganic growth. And in the last 3 years, West Europe has taken over from North America as being the primary region of focus for M&A activity in our space, certainly for our global 25 firms, with Europe accounting for at least half to 2/3 of all the deals they did in each year from 2018 to 20. Private equity interest in the sector is at a high. We've recently seen ERM secure a deal with KKR, valuing the 5,500 strong pure play at $2.7 billion, representing a revenue multiple of 2.6. And that value was $1 billion higher than its previous PE round 6 years ago. Deal structures are also becoming more innovative. For example, Jacobs acquiring a majority stake in PA Consulting, with this deal significant on a number of fronts. Firstly, because Jacobs has chosen to invest in a management and transformation consultancy, but also it's innovative because of the PE-like deal structure, which will help rapidly scale up PA's capabilities across Jacobs' much larger global operations. The deal multiple of 3.5 times PA's $700 million revenue sounds high, with the EBITDA multiple at about 15 times. But as I think Jessica and Paul will underscore, the multiples have been going even higher than that in some cases, and they'll talk about that shortly. And another of our global 25 firms, Tetra Tech, has this month announced an acquisition to bring in management consulting capabilities like Jacobs, but on a smaller scale through its purchase of the Kaizen company in the US. Also of note is the rise of complementary service platforms comprised of firms put together by specialist investment or holding companies. A couple of recent examples we've reported on include Align Capital Partners, which is behind Alliance Holdings, a multi-state EHS service platform, which recently added Almeida and Eros Environmental. And then in the UK, Palatine, which is a British lower to mid-market private equity, has backed deals involving 2 of the UK top 30 firms, Delta Simons and Anthesis. Palatine was a partner of choice for these 2 because of its dedicated ESG director, custom ESG framework and background in impact investing. And don't forget, this is a two-way thing. This industry is viewed as an extremely attractive space for investors looking to increase their exposure to ESG investments and deliver positive impact as well as financial ROI. And finally, for several years, we've thought it only a matter of time before a major tech firm or Big Four makes a move on one of our E&S providers. But instead, we saw it the other way around with Jacobs investing in PA. Last year, we did see the French IT giant Atos buy itself a sustainability boutique through EcoAct. But conceivably, you could also imagine one of the large corporate clients, financial bodies or energy majors moving in as a strategic buyer, needing root and branch knowledge in carbon accounting or nature-based solutions to drive forward their net zero targets. We're certainly seeing a lot of this cross-sector fertilisation. So I showed this slide last week at the first session of the Global Summit, but it's worth reiterating. We've done some analysis looking at all the acquisitions made by the Global 25 between 2015 to 19, which shows the most prolific acquirers and industry consolidators. And in that 5-year period, there were 4 clear leaders: Jacobs, WSP, Wood and Stantec. As you can see from the bar chart on the right, the figures tell us that there was a drop-off in deal activity through last year as firms turned their focus inward, but we're seeing a bounce back this year. Outside the Global 25, the management consultants have also been acquisitive, with Accenture, Bain and McKinsey amongst those acquiring ESG ratings and climate analytics specialists in 2021. And we've yet to mention the sector's deal of the year. WSP is joining forces with Earth and Environment specialist Golder to create a 14,000 plus strong global force in the space. And if we add in those acquired revenues through Golder and the other M&As WSP's completed in the last 18 months, WSP then becomes the industry's #1 acquirer, adding almost another $1 billion to the total shown here. And I'll leave Andre Martin and Tom to tell you some more about that soon. But what I will say is that the EA rankings data shows a meteoric rise for WSP in the space, with the company ranked in the low 20s at the start of the decade, rising to its current position of 4th. And we expect it to move up at least another place or 2 in next year's rankings. This chart also shows the overall consolidation impact, with the top 10 increasing their combined market share by about 5% in the last 10 years, with the 2 market leaders from a decade ago, URS and CH2M, having since been acquired themselves by AECOM and Jacobs, of course. Overall, our 25 market leaders have grown at almost double the rate through M&A than they would have done through organic growth alone, with a total compound annual growth rate of 4.7% in this period. And lastly, a quick final point to consider where growth strategies are concerned is whether bigger is better in this space. We've been hearing a lot about the need for scale, and specifically to be able to scale up rapidly to address new market opportunities emerging in this decade of action. But given the performance trends we saw pre-COVID, which showed the large multi-service players as a group struggling to find the right formula for growth in the environmental space, is it perhaps better to be in the mid-sized sweet spot and benefit from the best of both worlds, or to retain that pure play focus as a specialist? I'm sure the business leaders on the panel will have an opinion on that. But that's it for me, and back to Julian for the panel's perspectives. So thank you.
Thank you very much, Liz. Yeah, quite a sobering observation that growth doesn't necessarily bring M&A growth doesn't acquisitions don't necessarily bring an improvement in growth. For those who took a particular interest in Liz's presentation and the market data contained in there, this is really just a small snapshot of the intelligence that we offer to our member companies. So please do reach out to myself or to Liz if you want to find out more about how to become a member. But now, to introduce our panelists today, let me have a quick run through before I invite you each to give a short introductory presentation. So we have Andre Martin Bouchard, who's Global Director, Earth and Environment, and Global Executive Director for ESG at WSP. We have Paul Dondos, who's Managing Director at Equitech, the M&A advisory business. We have Tom Logan, who's President and Chief Operating Officer at Golders. We have Jose Revuelta, who's Chief Strategy Officer at Montrose Environmental Group. And we have Jessica Barkley, Managing Partner at the Environmental Financial Consulting Group, EFCG. So an incredibly well-qualified panel. It should be a good discussion. But can I hand over to you, Andre Martin, to kick us off with your quick presentation
Absolutely. Thank you very much, Julian, and thank you for having me on the panel today. It's a pleasure being here. Let me maybe provide the audience here with our WSP perspective on M&A. If you can move to the next and only slide that I have, please. Thank you. Well, WSP, starting with the right-hand column there on the slide. WSP has always had M&A as part of our DNA. Our growth story is impressive. We've been building a global platform of 54,000 people strong globally, and we've also grown our earth environmental capabilities quite rapidly over the last 10 years, but accelerated it over the last 5 years. So M&A has always been part of our DNA. And we have, over the last couple of decades, we've secured and we've closed over 100 acquisitions. I believe the exact number is probably closer to 150 acquisitions of all sizes. Actually, we've made mega acquisitions. We've made the Parsons Brinckerhoff acquisition back in 2014. The WSP acquisition that was acquired by Genevar back in 2012. Those were 10,000, 15,000 people strong. And we've recently closed the deal with Golder. So we've done quite large acquisitions that created our platform. But we've also been doing a number of smaller size acquisitions. We're not shy at making smaller size acquisitions as long as they bring additional expertise to our platform. In most cases, the firms that we acquire are existing partners. We have existing relationships with them, so we know them. We know their culture. We know their expertise. We know the type of client base that they have. So it's actually a rare case where we are in front of an acquisition opportunity and we don't know the firm that we are talking with. We often are acquiring smaller size firm that adds to our platform and for which we can leverage expertise that we can leverage across our WSP interconnected platform. So it's certainly also from a seller's perspective an accelerator of their own growth journey as well. They can access instantly more markets, more clients, and interconnect with larger, broader, and deeper expertise within the WSP platform. The pre-deal negotiation is key, and what I mean by that is the fit is always our number one criteria. When looking at a potential acquisition, we look at how the company fits culturally, how the company fits from an expertise standpoint, from a people standpoint, from a client mix standpoint as well. So the fit is extremely important. And the one thing I keep telling stakeholders is that it's important to not just having an M&A strategy and growth trajectory, but you have to have organic growth. To me, organic growth is your license to actually go after M&A, and it's the organic growth has to be driven by strong operations, strong fundamental operations. And of course, when we are bringing on board additional companies to the platform, we are always striving for generating additional revenue synergies, which in turn generate additional organic growth within the platform. So this is absolutely foundational for us to keep on growing organically and not depend only on M&A. If I move to the left-hand column there, from the WSP perspective, why do we realize acquisitions? It's a faster way to achieve our ambitions. WSP has always been very ambitious. We have had the ambition to build a leading platform for transport infrastructure, and we have done so. We have had the ambition to build property and buildings, world-class leading franchise, and we have done so. And we had the same ambition for our earth and environment business, and we have done so also. And it would have taken a lot more time if it wouldn't have been for acquisition. So we're now in the leading pack from an earth environmental consultancy perspective globally, with 14,000 environmental strong. With all our water people, by the way, our water people typically sits within infrastructure, but this is, you know, earth and environmental consulting people only. So it's a faster way to achieve our ambition. It brings, you know, diversification to our geographic footprint, of course, adding expertise. And one important point there, when I say adding expertise, is that it has to make sense for the clients. You know, the clients have to get it, and it has to add to the mix of services, capabilities, and expertise you can actually offer to clients. So, you know, it's not M&A for adding size and M&A for M&A. It has to add value to both, you know, ourselves as, you know, as an organization, but for our client as well. And of course, it accelerates value creation and career paths on both sides of the fence, by the way, not just for the firm we acquire, but for our own people, as we are leveraging also the acquired companies' network and client base and best practices. From a seller's perspective, you know, of course, it brings enhanced career opportunities for staff and people. It crystallizes sellers' equity. It provides access to additional markets that otherwise would be very difficult to reach. And it does expand capability to meet needs of sellers' existing client base. And we've seen that often where we've integrated a company into our platform, and they were able to serve their clients in a very well-defined area, and they were categorized as in a certain way within the client, within their client base. But then coming together with WSP, all of a sudden expanded the depth and breadth of services they were able to offer to those same clients. So it's a very important part of our strategy. It provided us the opportunity to grow to the size and to the relevance that we have right now on the marketplace globally. We were able to do it quite rapidly as well. You know, we're certainly different now than we were 10 years ago, massively. And you know, when you look at what happened with the pandemic over the last year and a half, you know, maybe over the early days of the pandemic, everyone was kind of, you know, wait and seeing. But we quickly realized that it wouldn't affect our strategic ambitions. And you know, we've actually made the Golder acquisition right in the middle of the pandemic. Started the file last fall. We announced it in December, and we just saw that, you know, despite the pandemic context, that the longer term ambitions were not different. So why changing our M&A strategy in the context of the pandemic? And we went for it, and we are now together with Golder integrating the firm, and it's a fantastic opportunity for us to achieve, you know, our strategic ambition that I've described earlier. So with that, Julian, I'm going to stop there. I believe I've probably done my 5 minutes, and I will turn back to you.
Thank you very much, Andre Martin. Yeah, and we're going to hear from Tom shortly, looking at the Golder and WSP story. But first of all, I'd like to give the floor to Paul to give us your perspective.
Hi, thank you. Paul Dondos, MD at Equitech. We are a global M&A boutique. We advise businesses that are coming to market up in their preparation for and through their transactions. We also help buyers, investors to find assets that work within their inorganic growth strategy, and accompany those strategies right through to execution. So that places us with the focus that we have, which is right across the knowledge economy, in a position to see the kinds of forces that are acting on this space from more directions, I think, than ever before. We've always been involved with owners of businesses that have been building their businesses, trying to get the best possible outcome out of a transaction. What we've found, and I think it's reflected in the survey that everyone just took, is that the interest of buyers, of investors, the force of capital, the complexity of the M&A marketplace is actually driving very high levels of buyer interest. And this is being reflected in the kinds of work that we find ourselves doing. So, we see the same things that have always been around through engineering consulting firms from 15 years ago when I was in corporate development for UK engineering firm. I remember putting down the compulsion to be active in inorganic growth to the need to keep up with the market at a rate that was greater than you could achieve with organic growth. That same fundamental is still acting in the marketplace now. I think it's become more acute. I think there's more competition for those assets. I think there's more capital there for them. I think that the mixture of innovation coming through digital trends, coming through business model evolution, coming through regulatory complexity and pressures means that it's harder than ever before for businesses in this space to be able to keep up with the demands of their clients and the demands of their shareholders just by growing through organic means, which of course doesn't stop them needing to be growing in that way. And any kind of M&A transaction needs to respect that and needs to play into that ongoing success. But it does mean that M&A is a more and more necessary and distinguishing part of the progress of businesses operating in this space. So look forward to the discussion here. I think it's a very lively time in the M&A market, presenting opportunities and challenges to participants on both sides of the table, effectively in M&A, and we've certainly been witnessing that on both sides of this with a great deal of attention.
Great. Good time to be having this debate. And yeah, over to you, Tom. Tell us the story from Golder's perspective.
Yeah, well, Golder was not looking to sell. Golder, it was well known to many in the industry that Golder was, we said fiercely independent, and we were a healthy partnership. We were profitable. We were growing, and everybody was content in proceeding on that journey. Having said that, we have an obligation, and I think most companies have an obligation to bring all serious offers to the board or to its partners. And so we felt that obligation. Now, having said that, we didn't feel an obligation to bring just monetary offers. In other words, offers for a lot of money where we didn't see a fit. So there wasn't that. We made it clear to our partners that we wouldn't entertain an offer from someone that we didn't feel was a good future. So again, we weren't preparing ourselves to sell. We weren't advertising that we were for sale. We didn't engage any brokers. We didn't do any of that. But we were approached by WSP, and it was tricky because we couldn't divulge who the offer was coming from. And so Andre Martin will testify that it was a very interesting process, because we had to approach 800 partners all over the world in the middle of COVID and explain to them that we had an offer, that we couldn't tell them who it was. We could generally describe the sort of company that it was, and that they had to not vote, but poll, take a poll and give an indication as to whether or not they would be in favor of proceeding with the next step. So we didn't know what to expect in that regard. We got lots of questions. We were able to answer some of the questions, and some of the questions were things like, well, you know, could we get a better offer than this? And of course, the answer was yes, we could potentially get a better offer than this, but we can't tell you what that is. So the other questions was, is this a company that values our culture and our services? And we were able to say that without divulging who it was. We felt that WSP did, in fact, value our culture, our skill sets. And it was a company that had what we had. WSP had a thriving environmental business, but wanted more of it and wanted to expand it to a wider client base and to a wider global footprint. So the poll was overwhelmingly favorable. You know, again, we had to be objective about it. We were not recommending it. We were not promoting it. But the partners overwhelmingly polled to proceed, at which time then we were able to reveal that it was WSP. Some of our partners were really good guessers and had actually preempted that news and guessed pretty well who it was, and we proceeded, and we're very pleased with how the transaction has gone. It has in fact provided a platform for us to grow, for career advancement for our people. Which was very important because a lot of the questions were, well, why are we selling to a strategic partner? Why don't we do a private equity deal? And the answer was that we could, if that's what they wanted to do. There was an option in the way that we polled and in the way that we held the process, where the partners could have said, you know what, we've decided that selling is probably a good idea, but we want to sell to a private equity. But that wasn't the case. The overwhelming majority said no. This is the right place for us, because again, it wasn't just about, you know, the money, and it wasn't about the potential to maybe get a better deal. It was, what does this mean for the future of our people and for the future career paths of our people? So that was a very important thing. And you know, I'll have to say that it's gone very well, as Andrea Martinez pointed out. The fit has been really good. Our people have collaborated and won work together. We've had, you know, mutual clients, and then we've had new clients, and all of them are overwhelmingly positive. And so we're very happy with the deal. But that's how it came about. People ask, you know, how do you prepare yourself to sell? We weren't preparing ourselves to sell at all. But I think we had always been preparing ourselves to be a profitable, growing, vibrant company. And I think if you do that, you're always going to be attractive. You will be attractive to people who want to buy companies. So that's my short summary of how this all came about and how it's going, Julian. And I'd be happy to answer any other questions that might arise. So.
That's great, thank you. Yeah, I got a quick question for you regarding the poll that you made of the partners. Is how far into due diligence had you got at that point, or was it before due diligence?
It was before due diligence.
Yeah.
It was before due diligence.
Yeah. So it was a question of the board making a recommendation based on your available knowledge, but with the proviso that there was a due diligence process to go through, which could change the picture, I guess.
Yeah, of course, because the offer at that point was non-binding. It was contingent. It's an offer contingent on due diligence and all the things that come with transactions like this. So
at that point, how many people in Golder knew the real details of the bidder and so on? Was it a really small team?
20
Okay.
20 out of 800.
Yeah. Okay. Yeah. Okay. Let me hand over to Jose now to tell us the Montrose story. I know you've been through a phenomenal number of acquisitions over time. So over to you.
Thank you, Julian. So hi, everyone. I'm Jose Revuelta, and I'm the Chief Strategy Officer of Montrose Environmental Group. Just a little bit of background about Montrose in case someone in the audience doesn't know about us. But we were founded in 2012, right? So we didn't have any employees at that time, right? And by now, I will say that we are 2,000 strong with 70 plus offices in the US, Canada, Europe, and Australia, right? So it has been a fantastic run so far over the last 10 years. And we feel that we haven't even started, right? Similar to what André Martin said earlier, right? Our desire is to become a global leader in environmental services, right? And when I mean environmental services, I mean environmental health and safety and sustainability, right? We can capture that in the word environment. And at the end of the day, that's our business, right? We don't do any other thing than that, right? And I think that's kind of a differentiator versus some of our competitors, right? That are on this panel and out there, right? So M&A is part of our DNA, right? We wouldn't have been able to achieve what we did over the last 10 years without M&A. But at the same time, right, as André referred in his introduction, the validation of our M&A strategy is on organic growth, right? And every time that we do deals, right, we look how those deals have performed and are we really being able to grow the overall platform organically, right? But as we all know, it's very tough to grow organically, right? And you normally tend to grow in the single digits. Well, Montrose's goal is to grow, call it 20% a year. We have been achieving over the last 10 years, right? So in terms of the services that we kind of provide, we do everything, right? From measurement analysis to regulatory compliance, permitting, emergency response, remediation. So we are kind of like vertically integrated, you could call it, in the environmental space. So just in terms of a little bit of numbers, right? We have done 56 acquisitions over the last 10 years, small and big, right? By small, I mean 2 employees with barely no profit to 200 plus employees, right? And similar, right? We have been, in the midst of the pandemic last year, right? I think it was in April 13 of 2020, when the world seemed to be falling apart. We actually closed the largest acquisition that we have ever done, right? And that gives, a sense of how convicted we are with our ability, right, to be able to change the game potentially. We see the environmental space as still as a very dysfunctional and fragmented market, and there is an opportunity for us and others to really come and through technology, right, to be able to change the game and help our clients solve today's problems, and not even today's problems, but also the problems that are already arising that they are going to come down the road. And in terms of M&A, right, I think it's really exciting times, right? The fact that so many people are chasing this space, because now, I mean, if you think of our industry, right, when it started in the 70s or even earlier, right, by the 70s, I mean, with the first Clean Air Act in the US, it was mainly regulatory driven, right? And now with all this sustainability wave, we have another driver in our industry that is going to drive growth, right? And that's why there is so much interest in the space, right? Because you know that through regulatory drivers, right, there is kind of recurring revenues that drive this industry, and now sustainability add that fuel to the fire, if you could call it. So I think it's great times to be in this industry, and for all of us, either buyers, sellers, right, that there is so much interest and there is so much sophistication to that extent that it's coming, that is going to allow all of us, right, to compete better and to that extent step up the game.
Great, thank you very much, Jose. Yeah, can I remind everyone to put your questions in the question tab? It's going to help enormously to get the audience participation. But yeah, let me hand over now to Jessica, if you'd like to give us your introductory talk.
Yeah, hi everyone. Good morning. It's very early morning here in Denver, Colorado. Although I saw, Paul, you're tuning in from Australia, which is incredibly impressive. Must be very late there on the other side of the world, but nice to, I guess, not see you all, but hear from you in the chat and read your comments and see you there. So my name is Jessica Barclay. I am one of the 3 managing partners at EFCG, which stands for the Environmental Financial Consulting Group. And we are advisors specifically to the AEC industry, the architecture, engineering, construction industry. So we work exclusively in this group, and we are an integrated advisor on the financial side, but also on the technology strategy side, working with companies to build, borrow, or buy when it comes to their tech strategy. On the sustainability advisory side as well, helping firms to pair their ESG goals with their core competencies to make sure that it's EBITDA positive versus negative, which it sometimes can be. So I work with firms in a lot of different ways, and I lead our M&A team. In my background, I started my career at Goldman Sachs, then moved to JP Morgan, and then spent several years running capital raising for a large private equity firm based in Denver. So I have been working with private equity firms, family offices, different types of financial sponsors my whole career. And I actually had a slide that I wanted to show, Emily, if you don't mind pulling that up, but how EFCG thinks about the M&A industry right now is in terms of waves of acquirers that are shaping our industry. And as you all know, the AEC industry is a highly, highly acquisitive one. We have had an undercurrent of small and mid-sized strategic acquirers since the inception of the industry, especially with talent as a shortage. Many firms acquire other firms, and as Liz pointed out in her first presentation, you can grow twice as fast through acquisition as through organic growth alone. The first big wave of acquirers to start to morph and change our industry were the ones actually that Liz mentioned as well. So Jacobs, WSP Wood, and Stantec, but also AECOM, Tetra Tech, NV5, Arcadis. We all know these big aggregators of firms in our industry that are impacting the M&A market substantially. Then about 10 years ago, we started to see a big second wave of acquirers come in and shape our industry. These are traditional private equity firms which take large majority investments. We've seen this many times through 3i, RTC Partners, New Mountain Capital, Longpoint, Windpoint, Bridgepoint, all the points. But these names have become very familiar to us. The biggest shift that we've started to see over the past couple of years is this new third wave, which entails different types of financial sponsors, including family offices, holding companies, SPACs, and lower middle market private equity firms that are looking not necessarily for that 30 million EBITDA platform acquisition or investment, but they're looking, I have firms calling me who are looking for investments as small as $500,000. So this is really adding fuel to the fire and materially changing the landscape of M&A. We saw this year already MSD Partners, which is the family office of Michael Dell, coming in to replace Longpoint to invest in Wolpert. The Pritzker organization, not to be confused with Pritzker Private Capital, which is also very active in our industry. 2 cousins in the Pritzker family who have their own family offices. But the Pritzker organization came in to invest in STV. We have pension funds investing directly in the AEC industry, as we saw with OMERS and AIMCO and ERM, who were just replaced, as Liz had mentioned, by KKR. But then we've seen a lot of smaller middle market firms like Copley Equity, Long Arc Capital, and then SPACs like Boxwood that aggregated Atlas Technical Consulting. And all these different types of capital are changing things so much for the strategic acquirers, making it a lot harder for your typical strategic firm to actually make an acquisition because the M&A multiples are increasing substantially. And I actually wanted to quickly address a question that we saw from Tim Curtis, where you talked about the prohibitive transaction costs involved with deals that are small scale. And that's absolutely true. So even though capital's flowing in, not just to the big firms, but to the mid-sized firms, capital's still not hitting those smaller firms as much. Firms with less than 25 million of gross revenue, the median multiple there has hovered around the 10-year average, whereas multiples in the mid-size and large firms have skyrocketed, and that's largely due to those prohibitive transaction costs, as you mentioned. By the time you're finished with the legal fees and the integration of the financial systems and IT and M&A advisors, you would have been much better off buying a much bigger firm. And so how do you wrap your heads around that? And we're seeing that come out in terms of the stratification of the M&A multiples. And there are opportunities for multiple arbitrage, but it's hard given those fixed costs when it comes to acquiring a company of any size. So that's it for me for now, but I really do welcome all of your questions. If there's one thing that I can leave you with, it's that no financial sponsor is alike. Each different type of financial sponsor and structure has such different personality, values, timeline, structure. It's almost impossible to see the entire universe. So again, I'd welcome any questions directly. I work with hundreds of these different types of firms. I've gotten to know them quite well. Happy to dig in more and answer any more specific questions. Thanks, Julian. Back to you.
Okay, thanks very much, Jessica. Let's get some panel discussion going. We've lost Paul at the moment, but we're trying to get him back. I think there may be a technical glitch. I wanted to kick off by asking about the boom in M&A markets generally, and I wonder, Jessica, if you could try and give us some perspective on why M&A generally has been such a hot market. What's creating the capital boom?
Yeah, so thanks, Julian. There are two things I believe that are creating this huge capital boom. The first is unprecedented dry powder from financial sponsors. And dry powder means capital that has been raised from different types of investment partners, pension funds, sovereign wealth funds, endowments, foundations, wealthy individuals. So that capital has been raised already into the private equity funds or different type of fund structure, but it has not been deployed yet. It hasn't been invested yet. And it just keeps on building. So there's now a record $2 trillion of this dry powder globally that has to find a home. It has to find an investment, or else that money will get pulled and those funds will never be able to raise another fund again, ever. So there's a huge amount of pressure on different types of financial sponsors to deploy that capital. And the second, and actually I'm going to tie in Rhiannon Ludlow's question here, is the industry seeing new strategic acquirers as entrants to M&A in this space? And the answer is absolutely. So all of my clients that we're seeing at EFCG, most of these firms, many of them got PPP loans, many of them have just done really well. They're sitting on the highest levels of cash that they have before that they have. And it's really financially savvy to use your balance sheet. If you're sitting on excess cash, that makes a lot of sense to acquire a firm. And that way it's more than a group hire. So you're getting talent, you're getting clients, you're getting backlog, you're getting new relationships. So it's actually a really smart thing to do with that excess cash. The problem is there are many more buyers than sellers. And so you're seeing this huge disconnect, and then that's what's really driving up M&A multiples.
Okay, so we're seeing trade buyers with spare capital. We're seeing huge amounts of capital floating around in the private equity world, and no one wants to sell their company. That's quite an interesting mix, isn't it? Yeah. So
it's a good time to be a seller right now. It is a very good time to be a seller.
Yeah. Let's look specifically at the way the interest in ESG is fueling the boom in our sector and related sectors. When I read these things, it all seems a bit glib. It's like, oh yeah, we want to invest in sustainability. Well, I mean, it's got so many different aspects as an issue. It's so complex. It'd be interesting to drill down and think, well, what exactly are buyers looking for in this market? So, do you have a perspective on that, Jose? Like, in what way is the ESG world fueling interest in the consultancy space?
Yeah, I think it's a matter of like they see growth potential, right? So if every firm out there it's putting targets of being carbon neutral, right, by 2030, 2050, how they are going to achieve that, right? And they are going to need providers like ourselves, right, or the ones in the space in order to be able to meet those targets, right? So the first is, do you put a strategy in place, and then how you are going to accomplish that strategy, and how you are going to audit, right, that those targets are being met in a timely fashion, right? So that means that for all of us, right, that are in the space or in the environmental health and safety space, that suddenly our clients are not just calling us to comply with, I say, with specific regulations. Now voluntarily, they want to comply with certain milestone or thresholds, right, or commitments that they have made to their shareholders, right, because their board of directors are getting a lot of pressure from those shareholders in order to be able to meet those goals, right? So historically, you were potentially doing things to be able to renew your air permits. Now, that's not good enough, right? And I think there is a lot of different ways that you can achieve that. So again, it's looking at that growth, right? If before I was selling you a project, right, for a specific permit in a specific plant, now I'm looking at you as a global potential company that wants to meet this target of being net zero.
Yeah. I guess I have a sense that capital markets don't always behave rationally, so I'm kind of concerned that there may be a risk of inflating an ESG bubble in the M&A market, and but does that is that a concern for you, Andre Martin, or do you think we're still behaving in the world of rational valuation?
Well, that's a good question, Julian, and whether this is a bubble or not, I don't know. But what I know is that there's a some fundamentals are changing right now, and the fundamental, I would say, ESG trend, I believe, is there to stay, as we are entering, a cycle of a real low carbon transition. And and what I mean by real low carbon transition is because we've been talking about that for probably 15 years. I remember Al Gore going around the globe in the early 2000s and 2005, 2010, and he was warning the world around climate change. And I would say the following 15 years, it's been a topic, but not necessarily something real and concrete that actually percolated into the financial markets and into businesses in general. So right now, I think it's real. Investors in the financial communities are seeing this ESG trend as being a way to invest and allocate capital in companies that are taking not just good care of their financial outcomes, but also all other outcomes that may be posing a risk to to future earnings and to the future of these companies they invest in. So they're looking for ESG type investments because, first of all, it's been demonstrated that ESG high performers are better performing, period, from a financial perspective and from a resiliency perspective. And now a lot of funds and pension funds and are looking at increasing their exposure into that space, into that ESG space. And this is where environmental consulting firms fall almost naturally. Naturally. So that's, I think, why it's fueling a lot of what we're talking about today. It also helps the business fundamentals of our own industry, because, yes, it provides us the opportunity to develop, and grow more advisory, sustainability, ESG, climate change type advisory services. But I also think that it also helps the traditional type services that we've always been doing for 40 years, the contaminated land, the air quality, the permitting, the ecology, the biodiversity, everything we do and we've been doing for 40 years. I'm just seeing right now more of our clients wanting to be, better with their performances related to their environmental, social, and governance. But the E is where a lot of money has to go, because these companies will be either repurposing some of their assets, looking at their portfolio, looking at their liability. So it's not just fueling growth for new advisory type services, but very good for traditional type services as well.
Okay. So welcome back, Paul. I know we had some technical problems. Pleased to see you back here. We were just talking about the way ESG is adding fuel to the boom, and I wondered if you could say, from your experience, what PE buyers, the financial sector is looking for when it comes to the sustainability angle. How does that translate into targets? What's hitting the spot for them? Oh, are you able to unmute? Oh, that's a shame. Looks like we've got problems unmuting Paul. I'll see if my colleagues can work with you on that. I'm very sorry about that. Yeah, Tom, do you have any thoughts on the sustainability drivers that we're seeing, and how that's going to be impacting valuations going forward?
Yeah, I agree with Andre Martin. I think it's good. It's here to stay. Our clients are going to continue to have to demonstrate that they are focused on all of the sustainability issues and the ESG field. The ESG field, having been in this industry for a long time, I remember when we were starting to be asked to do the S part of ESG, it was sort of a curiosity to us, because we'd always done E, and then clients started asking us to look at the social aspects of problems and M&A and their own issues, and so we developed a proficiency in it as a result of the demand of our clients. And then, all of a sudden, I started realizing, hey, they're actually calling this something. They're calling it ESG. And so, all of a sudden, everybody's picking it up, and that becomes the latest craze. But it was an evolution. It was evolution of things that clients were asking us to do, because we were already there doing something that was similar or it was a like service, right? So, and what's going to happen is we're going to continue with the whole carbon neutral thing. As that's a driver now, and you're going to see new acronyms come up. There's going to be another acronym coming up, and 5 years from now, there's going to be another letter added to ESG that we haven't even figured out yet. But it's going to be added because our clients need us to add it, right? And then we're in a position to solve the problems. We're in a position to help them with these things, because we're consultants in the environmental field. And as a result of that, we can adapt, and we can help our clients with those issues. But don't be surprised if 4 years from now it's ESG and three more letters added to it. So
sure, but we know that the asset management sector is going through a hell of a steep learning curve, trying to understand what all this means, and this is just one relatively small aspect of it, looking at the impact on the M&A market, and I find it really fascinating. So, Paul, are you able to participate now? So, I'm interested in the impact on the investment community.
Yeah, 2 laptops and a phone later. Apologies, but we seem to have got here. Hopefully, I'm audible now. I guess I've got time to make one point, really, which follows from my introduction, which is that at Equitec we cover right across the knowledge economy. So engineering consulting, environment consulting, sustainability consulting is part of that. What we're seeing dramatically is the participation from all elements of that, whether it's marketing, media, businesses moving into sustainability, whether it is management consultancies, even IT services moving in on the sustainability of component of the proposition they're offering. What does this mean for people in the audience? If they are buyers, they're probably in their commercial terms going to be facing competition increasingly from those elements, and in M&A terms certainly facing competition, which is driving those high multiples. For sellers or potential businesses looking for investment, looking for new structures, this means there is a greater volume of choice, a greater number of ways to make impact as part of a larger platform out there than there has been before. And I think that presents challenges and opportunities. And I think it's very difficult to be aware of the scope of that in your day-to-day businesses, in your immediate competition. We're aware of it because we're in the market, and so I want to bring that into the discussion. I think it's a very important component of what's going on now, along with all the financial sponsors, the capital that's also available and heating the market up in general.
That's really helpful perspective. Yeah, thanks. Yeah, and would you like to add anything to that, Jessica?
Yeah, so it's really interesting. And Andre Martin, it's funny to kind of rewind time and put ourselves back to when Al Gore was going around talking about climate change, and most people thought, what is he talking about? That can't possibly be real. And I actually, I have a very, very vivid memory of sitting in my office at JP Morgan, surrounded by 30 other people from JP Morgan. And it was a really bizarre weather day. And I had mentioned something like, oh, climate change. And every single person said, climate change, that's not real. It's not a thing. And I was looking around. I mean, this is not that long ago, maybe 8 years ago. And these are people from one of the top banks in the world who were like actual climate change deniers. And it just like absolutely shocked me. And so my dad, named Paul Zofness, who has he's dedicated his entire life and his career to sustainability and enabling change around sustainability. He was one of the co-creators in partnership with the Institute for Sustainable Infrastructure of the Envision rating system for sustainable infrastructure. And when that started, it was this like one-off, like, do you believe in it? Do you not believe in it? And now we're hearing this groundswell. And Tom, you had alluded to this too, but there's just this demand from all of your shareholders for some kind of ESG focus. And even looking at these financial sponsors, their capital, as I mentioned, comes from pension funds, and pension fund holders are saying this, we demand this. We need this. Sovereign wealth funds, the Norwegian Sovereign Wealth Bank is one of the largest sovereign wealth funds in the world, and the people of Norway are saying, hey, this is a problem. We demand this. And by the way, you need to invest in things that align with our ESG goals. So it's just, it's very exciting. And I agree with you, Tom, it's not going away. And I am excited to hear what will be added to that ESG component next. Will it be, ESG CN, like carbon neutral, or what will that next component be? And I think that for firms who think, oh, it's a phase, it'll pass, I think that they're really going to fall behind. And firms like WSP, Golder, Montrose, I know the ERM is a really big advocate and actually implementing this ESG change. And if I could just add one more thing. So my colleague, Dr. Andreas Georgoulias, who serves on the faculty at Harvard, but then also was one of the co-founders of the Envision rating system, has been doing a lot of research. He leads EFCG's sustainability advisory practice. And we heard him yesterday speak on one of the Environment Analyst Business Summit roundtables. But he's been doing a lot of research around publicly traded companies and mapping how much they talk about ESG and then how much they actually implement ESG, and found a striking, statistically significant result, which is if you talk about it and you don't do anything about it, it actually detracts from your share price. If you do a lot about it and don't talk about it, it doesn't reflect in your share price. So you have to actually talk the talk, walk the walk. You have to actually implement strategy, implement goals, and also articulate your value proposition and that message to your shareholders. And in that case, your share price, there's a material valuation bump to your share price, which is just, it's an exciting find, I think. So
great. Yep. So I'm going to take one of the questions from the audience, from Shane Maratonga. He's asking on Andre Martin. He's noting that most of your acquisitions were smaller businesses who were already partners, and he's saying, well, look, the Golder deal looks different from that because of the scale. And he's wondering, are there other targets of a similar scale that you were considering at the same time?
Well, thanks for the question, Shane. Golder is of course of different scale than the latest most recent acquisitions we have made at WSP, but not that much when you look at it. When you look at it holistically, a couple of years ago we've done Louis Berger, who was 5,000 people, and back in the history, we did PB, Parsons Brickenough, which was 15,000 people, and WSP 10,000 people. So the scale of acquisitions, of Golder's size type, we've done in the past. So we've demonstrated our ability to close these deals and integrate them efficiently and create value out of them. So we know that within the WSP platform, we can do deals of pretty much any size, actually. So it's not that much different. But zooming into the earth and environment sector, of course, lately we've done ecology environment, we've done Orbicon, we've done Elton in Australia, Liviansay, and other smaller size acquisitions. It's also a reflection of what's available on the market, the opportunities you have. There's so much things you can plan, in the M&A space, in the M&A activities, and you have to actually seize opportunities when they come. So that's probably more of a reflection of the market and what's available to us at this point, and also the decisions that we have made on go no go on some of these available companies.
Sure.
So it's yeah.
Okay, thank you. Yeah, and I got a question here from my colleague, environment analyst Vanessa Spedding. She's asking, does the panel have a sense of how or if the global environmental sector might be reordered in the longer term by the M&A boom? For example, whether there will be increasing consolidation, more or less vertical integration, etc. I wondered if Jose would like to take that. Seems right up your street.
I think that the market is open, right? It's up to all of us players in this industry to decide how is it going to be consolidated. But that's not an if, it's a when, right? I mean, I think that our clients are asking us to support them in different ways, right? And if you think of the large corporations right now, if you look at who are their vendors from an environmental, ESG point of view, environmental health and safety, they have hundreds of providers, right? That they are not talking to each other. And to that extent, I think that there is going to be a consolidation in the fact that eventually there is going to be 5, 6, 7, 10 champions, right, in this industry that are going to be able to really provide global services to those global clients that are demanding that global solution. So again, I think the consolidation is just a matter of when, not an if. And it's up to, again, us to decide if it's going to be horizontally integrated or vertically. In the case of Montrose, we are doing it vertically, but many other players, right, they are doing horizontally. And by that, I mean that there is a clear differentiation between the firms that are more on the testing side versus on the consulting and engineering, right? So to that extent, because of our success, maybe other firms are going to reconsider, right, the fact of it might make sense to combine those, call it testing, measurement analysis, with the traditional consulting and engineering.
Interesting. Tom, do you have a perspective on the pace of consolidation and whether vertical integration is going to become more of a thing?
Yeah, I do. But the larger and larger firms, especially in the environmental space, are becoming fewer and fewer. So I think it's going to continue, but there are going to be fewer large plays out there in the market. So it's going to take a lot more acquisitions to take significant leaps and significant share of the market. But organic growth is, as Ender Martinez pointed out, I mean, we are in a huge boom market right now. The demand for our services and the activity level just in the marketplace outside the M&A space, just the demand for our services is causing a huge uptick and a huge demand for talent the winners are going to be the people who attract the talent in the very near future. Not the companies that can buy big companies. It's the companies that can keep turnover down and hiring up. That's who's going to grow.
Yeah. Andre Martin?
Yeah, well, totally agree with what Tom just said. As for the challenge we have with keeping and recruiting talent and meeting the client's demand, we are under a hot market, and it looks like it's going to be like that for the foreseeable future. But to get back to your question, when you look at the environmental consulting market, it's still a fragmented market. Yes, there are larger players becoming larger and larger, but there's still a number of mid-sized firms existing, small-sized firms existing. It's still, I believe Jessica will probably agree with me, it's still considered a fragmented market. And certainly when you compare with the Big Four type markets and those markets that are extremely consolidated. So I think there's still ways to go. Bringing companies together will provide, I would say, probably better vehicles in the future to address the more complex challenges of our clients. I'm convinced of that, especially with connecting that with what we discussed earlier around ESG. So it's not just being able to serve clients with their contaminated land or and whatnot. It's to be able to meet the client's challenges with their carbon transition, ESG strategic planning, yes, portfolio management of liabilities, etc. And I believe that more and more the smaller and mid-sized firms will face a decision. Will they be able to keep up with that market getting complexified and being able to meet their clients' demand? And one of the solutions to that is actually consolidation, and joining up with a larger firm that can actually achieve just that.
Yeah. So, Paul, I think you've been able to dial in. Are you able to?
I am.
Oh, that's great. Thank you. We were just looking at a question to do with consolidation, and we perhaps I could put the question this way: why hasn't there been greater consolidation in the environmental consulting space? As we're still seeing it as quite a fragmented industry. How will the M&A process over time bring more consolidation, and is that likely?
Mm-hmm. Yeah, so agreed that there's still fragmentation, but I think that's bound to change as the buyer and investor interest is accumulated and translates into transactions. If you go back a bit and look again at the broader picture, from financial sponsors that were the most reluctant to engage with people businesses until relatively recently, that there was an unfamiliarity, there's a risk about any kind of business that depends on assets that walk out the door at a certain time every day to maintain its business. That comfort with these kinds of assets in general has only come recently. That's on the financial sponsor side. On the strategic acquirer side, I think that again, these are complex assets with intangible benefits, propositions that are niche, that are difficult to translate with confidence into the value that they represent. In the same way that as those have start to unravel now, they seem to be all the more valuable because they play into so many different aspects of larger companies' propositions. But that complexity in the first instance is enough to keep M&A at bay, essentially. And I think as those have become understood, the interest increases exponentially because as they are understood, it's seen that it's not just about being able to build something that's better for the environment. It's about something completely different. For example, it is about having to have a supply chain that's responsible, which is the concern of operational consultants, of management consultants, and so on. So I think that in the same way that there's been a delay, that the pace has been slow in consolidating the market in this area, I think that the same will be, I think that the increase in velocity is really going to be great. It's going to be remarkable now.
Okay.
And if I could actually add on to that. So, Andre Martin, I completely agree. The market is very fragmented. In the US alone, there are 75,000 registered engineering firms, but there are only 1,200 firms with revenues over 10 million. So it actually scales, that tail is very, very long in terms of the 1 or 2 person shops or the much smaller firms that you have there. And then, it's interesting. I agree that we'll continue to see more consolidation, and especially, Paul, to your point, where we're seeing increased buyer interest in professional services firms. But at the same time, and it's not quite keeping up with the pace of consolidation, but we are continuing to see a lot of proliferation. As firms are acquired or as engineers spend a few years at a company, get up to speed, the barriers are relatively low to start your own engineering firm. And I think, again, not quite as consolidation is not quite as quickly as consolidation is happening, but pretty quickly we're seeing continued proliferation. Jose, you started your firm less than, or I guess 10 years ago, and you've already scaled up through 59 acquisitions. I mean, that's amazing. That was a firm that started from scratch, from nothing, and scaled up so big, so quickly. And we'll continue to see that. And that's the cool and exciting thing about this industry.
Okay. I'd just like to take another question here quickly. I don't want to dwell too much on it, but Stephen Whittle has asked a very pertinent question, which is, given the higher multiples that we're seeing, that presumably is going to have to translate into higher profit margins, because someone's got to pay for the investment, right? So is that the world we're entering, one where consultancy services are going to have to become more profitable? How do you see that, Jose?
That's a challenging question, right? At the end, it all comes down to supply and demand, right? What is our competition willing to offer the services at, right? At the end of the day, I would love to price my services a lot higher than I do it right now, right? One of the questions I ask myself every day is why a lawyer can charge $1,000, $2,000 an hour, and an engineer that is doing the same work, right, only can charge $300, right? The top engineer, right? So at the end of the day, is the industry going to be willing to swallow the fact that I want to pay my engineers $1,000 an hour, right? Charge my customers for that. I think the price, the market is not there. And my competition, right, is willing to offer those lower rates, right? So at the end of the day, is that constraint. At the end, again, because it's supply and demand, as we have been speaking, right? If there is more demand for those services and those experts are fewer, right? At the end, that's going to drive potentially an increase in profit margins. But I think more than that is just the overall growth, right? At the end of the day, if you are able to bring more people into the industry, if you are able to generate more revenues, even if it's at the same profit margins, right, you are potentially able to repay your investment.
Okay. Yeah. So repaying the investment isn't just about margin; it's also about growth in the business. Yeah. I think I'm going to park that one there. I think it's a kind of fun question, but we could talk about it forever. I got another one here from Lucy Morton, who's asking, what are the things that you can do as an acquirer to successfully integrate staff from firms that you have acquired, so that you retain the staff that you acquired and realize the benefits of the acquired company? And I think I might start with Paul on that. If we still got you on the line. So what are the things we can do to successfully integrate staff? It must be a question that comes up a lot.
Sure. Well, I think as has been referred to earlier, a lot of that comes before the transaction, right? It's actually in ensuring that there is even the possibility for a strong cultural fit in the first place. But assuming that the basics are there are different models that you can follow. there has to be a definitive plan for integration at the beginning of the period. But that can leave integration of brands in different models. I think the most important thing is to establish prior to the acquisition that there is the potential joint go-to-market. And I think that everything then follows from that. And answering this at a high level. And I think that is a key factor to determining the success beforehand, and the sooner that that's processed into results, the top line, the better.
Thanks. And what's your thoughts on that, Andre Martin, about how to integrate staff successfully?
Yeah, well, that's a very important question, and certainly key to success in making this acquisition is how you can successfully integrate it. I think it starts with how much the deal makes sense. The deal has to make sense. When the deal makes sense for shareholders, but also for clients, and there's no duplication in terms of the capabilities you bring in, and the people are happy collaborating together, it will ease a lot the integration. So again, it goes back to the cultural fit and the fit of the companies coming together. But more specifically in terms of integration approach, that I think makes it a success is, at WSP, we've always had a very open-minded approach to integration. So we're not dogmatic about the way of doing things and the way we integrate companies, because every company we acquire brings something new to the table, brings new best practices that keeps improving our own platform. So there's a lot of actual value in not just bringing the acquired company into your platform, but to actually leverage what the acquired company brings to your own platform, which help with retention and help with providing access to great careers to some of their leaders. And I think we have to take a very humble approach when we make integrations. We don't own the truth, and then they have to listen to the truth. It's actually a dialogue where we have to make a decision based on best practices and also best athlete. So when you appoint leaders, when you put people in leadership position and you integrate teams together, you look at what's the best decision for integrating the groups together, and that will promote collaboration. And the one additional point that I will make, and maybe Tom can complement that answer, but there's nothing better than winning work together in a very quick turnaround time after closing. Winning work, collaborative work, bringing people together on joint projects early on in the integration. I find there's nothing better than that to actually build bridges, have people working together, have the cultural blend coming together, and so practices, processes, and so on and so forth. There's so much things you can do in conference rooms and virtual meeting rooms and training rooms, but it actually comes out through when you work on projects.
Okay, yeah. Do you want to follow on, Tom?
Yeah, no, obviously I agree with all that. I think that for me, it's making sure that the firm you acquire has a seat at the table. You have to give them a seat at the table. You have to have them involved in joint decision making on leadership, as Andre Martinez says, best athletes play. People have to feel like they've been given an opportunity to take on leadership positions at the new company. And I can always tell on our calls, Andre Martin and I have calls all day long, I can always tell when things are going well, because you'll have 30 people on a call and you can't tell who's WSP and who's Golder. And when you can't tell that, then things are going well. When you can tell that, because one's acting like a buyer and the other one's acting like the buyee, then things are not going well. So.
Okay, interesting. Yeah, Jessica, you must have you must be aware of examples where there hasn't been a successful integration of staff. What are the hazards to look out for? What are the mistakes that people can make?
It's funny, it often boils down in that post-merger integration, wherever there's friction, to things that seem really small, like in office or remote, dress code, timesheets, and understanding that ahead of time and getting ahead of those key issues is really key. I would really challenge acquirers to make sure that you're asking the head of the firm that you're acquiring, what drives your people? What makes them tick? What do they really care about? Is it free lunch Fridays? Is it, casual dress code? I mean, it's amazing to me that there are things that are so small that make a difference. But there are also larger things like healthcare benefits and how parental leave, and if it really doesn't jive with the benefits that you came from, you're not going to want to stay at that firm very long. So just making sure that the leader of the company that you're acquiring understands what drives his or her people, and then figuring out how you can integrate that. You also don't want to have second-class citizens in your firm. So you really can't, maybe the firm you're acquiring had great healthcare benefits, but you're not going to change your entire policy at your firm. And then you can't have half the people or a fraction of the people at your firm with materially different benefits from the other one. So thinking about different solutions and strategies to come around those, there's absolutely no one size fits all solution. It gets really nitty gritty and complex, but just thinking through that. And it's such a good question to ask, making sure you're thinking through that before the acquisition actually goes through, I think will help set you and your firm up for success in that acquisition. Yeah,
it's easily overlooked in the heat of the due diligence, all the technical work that's going on. Yeah, Jose, you must have pretty detailed perspective on this with 56 acquisitions under your belt. So what's your recipe for successful integration of staff?
Yeah, I will say that it's an art, right? It's not a science. Every acquisition is different because you are dealing with different people, right? So I agree with every comment that has been made by the other panelists, right? At the end, it's all about expectations and communication, right? And how you make sure that you are over communicating, right? I think that every employee out there, when there's an acquisition, they have heard horror stories, right? From colleagues or from family members. So the fact to reassure everyone that they have a job, right? That you want them, and try to explain them, right? Why you did the acquisition, right? And just make sure that they matter, right? At the end of the day, if you ask me what worries me the most, is my employees, right? Because if I lose my employees, I lose my business. So as you say, it's hard as you do an acquisition, there is so many things that you need to focus, right? That sometimes you overlook a simple aspect, is how people are really feeling about stuff, right? And that matters, right? And to that extent, I think we have learned a lot of hard lessons, right? We have made a lot of mistakes, right? Through the last 10 years, to the last 56 acquisitions, and we try to learn from every mistake that we make and kind of like implement, right? And to that extent, get our HR teams involved from very early on to really set the expectations and over communicate to try to retain everyone.
That's great, thank you. So I'd like to switch the conversation now to the subject of preparing for sale. I'm aware that only 2 people in the audience said that they were planning to sell, but maybe they're not telling the whole story. I don't know. Maybe people are instinctively coy about these things. In any case, it's a question that's of interest to buyers as well. What steps should a company be taking to prepare itself for sale in the next 3 years? What are the most important things that it can do in order to be an attractive target? Do you want to offer some thoughts, Jessica, on that?
Yeah, if there's one key thing that I can say about making sure that your firm is prepared for sale, it is getting that next tier of management in place. It is too often that I'm approached by founders who built a great company and they're looking to retire, and they call me and they say, I want to retire by the end of this year, or maybe by next year, or even 2 years from now. And it's almost too late by then, especially if they're the ones who are still driving a lot of the client relationships and business development. We are people businesses. So if a firm is buying a business where the key person is going to walk out the door in less than a couple of years, then it really erodes the value of that company. So I would really urge any of you who might be considering a transition for your company to start talking to an advisor immediately, so that you have that 5-year runway. Because even if you don't have that next tier of management in place today, if you're planning on staying on for 5 years, that's okay, and the acquiring firm can help establish that next layer. Or the alternative, which I've worked with one of our clients on, that actually just went under LOI for twice what they had expected, which is always very exciting news. But they came to me 2 years ago with no second layer, wanting to retire, and we said, look, you can't go to market right now. Let's work with you to establish the second layer of management so that you can retire. And so they did that really well. They have a great next tier. They actually have already stepped down at the beginning of this year, even before they sold the company, but they have this all-star lineup for that next layer of management. So it looks really good. And then you can add back their salaries, which are very high, to that cost, because they're actually they're no longer doing any work for the firm. So that's a really good way to structure it. But it just remember that you as a business owner are probably the key person, and how do you kind of mitigate that key person risk at your own company?
No,
Succession is hard, though. It's very hard.
That's great advice to owner-managed businesses. Yeah, Paul, you must have some advice you could offer people who are looking to prepare their businesses for sale in the next few years.
Sure. Following from Jessica, really, you don't get paid for your business at a price. A buyer or investor is making an investment that they expect to see a return on, like what, just to point back as well to the comments earlier about getting things to be more profitable, getting the value proposition to be more effective, and therefore being able to charge more, to grow faster, right? So the perspective from a buyer is not the same as from it might be internally. It seems obvious, but one way of that being manifest is through having the next layer of management. It goes broader than that, because you need to make sure that the value of the business is in the business and not just in the people, which doesn't detract from the value of the people that you have. But if you haven't coded the quality of what you do into the platform, that platform will not be scalable, and therefore it's too risky to be acquired or even invested in. There are lots of different attributes to that. You can actually be quite scientific about it, benchmark about that, all around the effectiveness of the market proposition, the quality of the fees, the quality of the clients, the IP that's in the business that distinguishes the way you do things in the management level, at the sales level, at the delivery level. It's the consultant loyalty, it's the sales and marketing processes that you have, and so on. There are ways you can look at a business that is about people and ensure that the value is codified into that business sufficiently to demonstrate that the growth is possible, the rise in profit is possible, to make it a good investment rather than a prize for what may be a spectacular achievement.
Yeah, that's great advice. Yeah, so what we're talking about is being able to demonstrate that the business is scalable and that other individuals could come in and do the kind of work following the kind of model which is described. Incredibly difficult thing to achieve in consultancy when we all know there are key individuals. So that strikes me as an amazing balancing act, and it's one that must be being followed through all the time. I mean, does that chime with you, Jose? Do you see this issue about demonstrating scalability? Oh, sorry, I think we're on mute.
Sorry about that. Yes, I say kind of like yes and no, right? At the end of the day, I think that we're very different, right? In the sense of, when we look at acquisitions, we look at the different aspects, right? I think people, as we all mentioned, is one key factor, right? Who are going to join your team? Can we work with them or not? Do they have similar beliefs? Do they share the same mission and things like that, right? But at the end of the day, being able to scale, there's a lot of great firms out there that they just don't have the ability to to scale for a host of different reasons, right? And I think our job as being building this platform is to allow them, right, to get to that scale that they wouldn't be able to get on a standalone basis, right? Because of the investments required to achieve that. So I will say it's a tricky answer because it's just no, right? It's at the end of the day, what am I really looking when I buy a firm, right? I'm really looking to expand in a new geography. I'm looking for a new expertise. I'm looking for a new client base that I wouldn't be able to get access to otherwise. Because as we all know, right, many times when we go to talk to a client, the first question is, what's your experience in this specific topic, right? And in many cases, for us to be able to have that expertise, you have to buy it, right, in that geography. Because in many cases, you could say, look, I have the expertise in California, and the client is in North Carolina, and he's going to say, great, but I want someone in North Carolina that has done deal with this issue, right, and knows the regulators here in order to help them. So that's the tricky thing and the challenge with that question.
So you're picking off market opportunities there, but what are the warning signs that would put you off a company even if it was providing you a new market opportunity?
I will say that one, it's always people, right? When you meet the leaders of a company, right? Meeting them at the end of the day is a reflection of everyone else that works at that firm, right? So if I don't get a good feeling that I'm going to be able to work with them and or employees are going to be, that's the first red sign. And the second one is more from a financial point of view, is always follow the cash, right? Every time that I get financial statements, right, I look at the cash flow, I follow the cash, and that's a really good sign to see how healthy a firm is from a financial point of view. But that's always the second check. The first one is always, people, because at the end of the day, if they were to leave, as we all relate to, you will be losing that business.
Yeah. Okay. Andre Martin, do you have any advice on someone preparing to sell their company in the next few years?
Yeah, well, let me just start by saying that I agree with what Jose has said. There's no real one-size-fits-all approach. I don't think so, to be honest with you, because the company carries its history, the company carries its brand equity. So it's almost like you've been building your company and setting it up for potential sale. Eventually, you don't know when. So everything you do through the course of your history will be taken into consideration. So that and in WSP, we've done acquisitions sometimes that were based on the fact that great expertise, not necessarily great financial at the moment we acquired, but great brand, great expertise, and we knew. We were confident we knew what we needed to do in order to bring the financial back on track in a very short turnaround time. So there's deals we've done with fantastic companies with great financial performances at the moment of closing. Some others that were different. So they all have their own story. So it's a bit different. And I'm just going to reinforce a point that Jose made, as a lot of things comes together when we are meeting up with the leadership team, and it's confirming assumptions or not, and this is where we bring confidence into the decision that we are going to be made on a specific deal.
Okay, I think I've got time for one more quick question before we go into the Remo networking session, and that's. My colleague Liz has asked about the branding issues. So, she says, what are the sensitivities and pitfalls when you acquire a company like Golder, which has huge brand equity in its own right? So I think maybe we could get Andre Martin to talk about that directly and then ask Jose about branding as well.
Sure. Well, that's so much important. The brand equity, every company, every firm carries its own story, its own brand equity, and certainly Golder is a very, very strong brand in our market. So, we are very careful on how we handle brand transition. Obviously, we all know what the end game will be, but the transition and the timing of it will be guided by will be guided by, how ready the market is, how ready the client is, how much brand equity we've been able to transfer over to WSP. So we're very, very careful, and we're very conscious of how important the brand is to some of the stakeholders involved. Interestingly enough, once the deal is done, the acquisition is made, you oftentimes realize that once you're started with your integration journey, it's oftentimes coming from clients and from employees. When are we moving on? When are we going to transition over? So it's something that we're extremely careful. We want to protect, and we want to transfer, and this is something that's also being done in collaboration with the acquired company, especially in the Golder's case. We're not going to take those decisions by on the WSP side by ourselves. It's a discussion, and it's a transition strategy that we'll put together with the Golder senior leadership people.
Okay.
And
Jose?
Tom, maybe you can comment.
Yeah, no, absolutely. Andre Martin talk about brand transition quite a bit, and it's, for me, it's when clients view the services that Golder provides synonymous with WSPs, that's the time to get rid of it, right? You want them to think, when they think your services, they want
Right.
you want them to think WSP, and that's when it goes. But to go back to your earlier point, when you were asking Andre Martin if he had advice for anybody that was looking to sell, I thought he was going to say to call him immediately after the this whole thing about buyers and sellers, just to clean up, and I think Jessica will acknowledge this. At EFCG, every year they do the same poll. There's always more buyers than sellers. But the fact of the matter is,
by a factor of 10 usually.
Yeah, by a factor of 10. But the fact of the matter is, everybody that gets bought was buying. So Golder, we were acquiring. We would have said we're buyers. If you'd have asked us, we would have said we were buyers. We weren't sellers, but we sold. So the only ones telling the truth are the buyers.
Okay. Yeah. That makes sense. Yeah. Jose, any thoughts on brand?
I agree with everything that both Andre Martin and Tom said. At the end of the day, we know what's the end goal, right? To have one brand and for everyone to be part of it. But I can say that there is firms, right, that we acquired back in 2012, right, in our very beginnings, that we're still using that brand, right? Just because it has such a reputation in the local market where they play, that, as you say, we're just very, very careful. While other firms, we were able to transition them into our brand within months of doing the acquisition. So at the end, we listen to our customers, we listen to our employees, and when both of them feel ready, what we do from day one is kind of like call it in the logo. It seems very simple. It's just we put a Montrose company right underneath the logo. Yeah. We start changing kind of the colors, right, to blend them into the colors of Montrose, so people start having that perception that even though you are using that brand, that they're also part of a bigger group. Okay, great. Well, we need to draw a line under it there and move on to the Remo networking platform. But many thanks for a great job. So yeah, thanks Paul for sticking with us in spite of the technical problems, and thanks to Jessica, Jose, Tom, and Andre Martin. And the my colleague is going to put a link to the Remo session in the chat. Hopefully, there we go. For those who haven't used our virtual networking platform before, it allows you to talk to your peers and move around a room of networking tables, each of which is its own private video conference, video conversation, I should say. You just double click on the table to move around, so you can decide where to sit. You need to make sure you toggle your camera to turn it on and your microphone to take full advantage of the facility. But there we are. Thanks very much, everyone, for joining us today, and we hope to see you in Remo.
Thanks, Julian. Great to be here.
Thank you, Julian. Thank you, everyone.
Thank you, Julian. Bye-bye.